Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Peter Hodson, Chief Investment Officer and President at I2I Capital Management, will be joining us for the hour. In 30 minutes, we'll be talking to Vivian Tu, social media's rich BFF, on her latest book, Well Endowed. And we want to hear from you this morning on First Call. Reach out with your questions, and we'll have Peter answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes. And our email, if you want to do that, firstcall@bellmedia.ca. Now, some of the stories we're following for you in the BNN Bloomberg newsroom. PowerCorp has appointed former IGM Financial Chief Executive James O'Sullivan as its new president and CEO. O'Sullivan will succeed Jeffrey Orr, who will become vice chair of the company. Power says the leadership changes are part of a well-planned and robust succession planning process. The new leadership will be effective in July. TFI International saw a drop in profit and revenue in the fourth quarter. The Montreal-based company says the drop was primarily due to reduced volumes driven by weaker end market demand. The trucking company raised its dividend in the quarter and repurchased more than $200 million U.S. worth of shares in 2025. Shares of Palo Alto are down in the pre-market about 6.7% after the company lowered its earnings outlook for the third quarter. The cybersecurity company's decreased outlook comes as higher memory prices and the cost of integrating new acquisitions continue to weigh on results. Despite the new guidance, the company reported a strong second quarter, beating estimates in both revenue and profit. And now our top line story. Meta's chief executive officer, Mark Zuckerberg, is scheduled to testify today in a trial over allegations that Meta and Google intentionally designed their social media products to be addictive to young people. It's the first of its kind trial, and it centers on a 20-year-old woman who says her nonstop use for more than a decade caused her to suffer anxiety, depression, and body dysmorphia. Thousands of similar cases brought against the two companies, as well as Snap and TikTok's parent company, ByteDance, are pending in court. Now, to get some thoughts on this, the precedents of it, we're bringing in our guest for the hour, Peter Hodson, Chief Investment Officer and President at I2I Capital. Peter, thanks as always for joining us. Good to see you. I haven't seen you in a little while.
Good to be back.
Are you on social media?
A little bit, yeah. I mean, I've got 4 kids, so I kind of had to sort of join the party and see what they were up to. TikTok is pretty addictive.
Are you friends with any of them on any? No,
I don't want to
be friends with them.
They're older now, so yeah. I don't want to get involved in that. But they are addictive for sure, and I've seen some young people really sort of waste their day on some of these products. But the thing is, it's not the only addictive thing out there. We got gambling, we got alcohol, we got energy drinks. And it's very interesting from a point of view in terms of what these companies might do, but it's not going to destroy them from an investment standpoint. They can adapt. Australia has put in restrictions, and they continue to carry on. And of course, these companies are just massive cash flow machines anyway, so they could afford to pay somebody out if that was the case that ended up from this plaintiff. The other thing is TikTok and Snap settled out of court. So maybe these other companies shouldn't have got to this point. With this one plaintiff.
I mean, I guess they could still settle out of court. Is it cheaper for them to settle out of court, or does it carry a bit of a stigma too, do you think?
Yeah, I mean, absolutely. Like, if you can get a confidential settlement and let everything just go away and put the media hype down, then obviously that's probably a preferred solution. But these are also, it's going to be a hard thing to prove. Everybody basically knows that they're addictive, but in terms of whether there's malicious intent in using that data. And again, I think they're probably guilty, but the actual repercussions of that may not be as bad as people think.
Could you see courts ordering them, though, to change their ways?
That's going to be a tough call. I mean, we have restrictions on cigarettes, for example, where they're allowed. And
that's where a lot of people were arguing. They're saying, look, cigarettes did it to alcohol has done it too.
Yeah.
They kind of lied. They fudged numbers and things like that. And they say that's what's happening with this. But could you see that happening?
Well, they could do things like have user warnings, before you log in. It's like, hey, this is addictive, and then just carry on from there. So certainly there's remedies that could be made, forced to be made. And again, I have no idea what they could be other than beyond sort of some controls or timing controls. But once you're once you're 18, it's very hard to do any restrictions. You're an adult, you can do whatever you want, and the government shouldn't tell you what to do. But that's a whole other discussion.
But and from a business point of view, I mean, I think people will be watching this, but I don't think they're going to blink that much unless it was some kind of an insane ruling.
Yeah, unless it's like a monster $1 multi-billion-dollar settlement with very restrictive conditions about timing and what you can do and how if young people could be forced to only spend 1 hour, if things like that, that would be negative for sure. But again, from a stock point of view, with all these companies, their developments in AI and other initiatives, it's not going to kill these companies. You might see a small correction in some of their stocks. And you may see a settlement, that hurts their earnings for 1 quarter, but they'll just move on. Like some of the banks, they always get in trouble. Like J.P. Morgan gets in trouble every once in a while. They pay $4 billion and carries on.
Cost of doing business.
Exactly.
Could Zuckerberg's testimony? I mean, I think it feels a little bit unusual that he's going on the stand, but could that hurt? I mean, could it go? I guess it could go either way. What would you be listening for with this trial?
Basically,
from a business point of view.
From my point of view, and maybe from a business point of view, I think you want him to acknowledge the fact that they know that that's a problem. Not necessarily that they've abused the situation, but they're aware of the situation, and have him describe sort of what they've done already to perhaps protect the young people. Now, I don't know what that would be and what he's going to say, but I think you want to. Again, because it's fairly common knowledge that these things are addictive, but you want him to show that they've had some sort of mitigating responsibilities and try to minimize the damage or minimize the influence. And again, I don't know how he's going to do that, but that would be preferable if he could come up with, say, this is what we've done to address the issue already.
It feels like to a degree, social media may be at a crux. I know myself, I'm pretty much off all of social media now. I used to be on it all the time for work. But when you do go on, the algorithms are exhausting.
They really are.
Because they eliminate choice.
They really do. Yeah.
I can't stand that. I don't like being told what to do, and I don't know if other people are feeling that way, and you're just seeing people move away from it.
Well, from a personal point of view, if I'm on TikTok, there's lots of things that I've been interested in that kind of disappear, and I'm like, hey, I want them back, and I don't know how to get them back.
No, and then they're going to go, here, this is what we're going to do.
This is what you're going to look at now, exactly.
Yeah. And I think a lot of people don't like being told what to do. We'll leave it on that note right there. Coming up, we'll take a look at the markets before the bell. All right, let's see how things are shaping up on the markets. We'll start with U.S. futures and a multi-year deal between NVIDIA and Meta, along with easing AI fears, for now, of course, are moving the markets in the right direction. You can see Dow up by about a quarter, and the NASDAQ up by a half, and the S&P 500 up by about 0.4. Taking a look at the Asian markets, still most of them closed for the holidays there, the Lunar New Year, but the Nikkei, Japan's open, it is up about 1%, and that's that post-election rally being extended on some strong export data. Heading to Europe, markets there digesting the news that Christine Lagarde may leave the ECB before 2027, but there will be a continuity in policy, and everybody's happy and in the green right now. FTSE heading towards 11,000, it's up 1.1, CAC 40 up by a half, and the DAX up by 0.8. TSX now, and finished the day down yesterday after that big bounce back on Friday, closed for the holiday, of course, on Monday. Basic materials, other commodities, dragging the market down about a half point, 0.54% to below 32,900. Some of the winners and losers: MDA Space up 6%, TerraVest Industries up by 5.9 roughly. Going the other way, Fortuna Mining down by 6.3, and SSR Mining off by 7.8. And looking at the metals, bit of a bounce back for them. Gold pushing back up towards the $5,000 mark. Silver is up over 75, approaching 72. It's been on a roller coaster for the last year, but for the last couple of months especially. And copper is still hovering around that 5 3/4 mark, 5.78 right now. It's up 1.4. Over to oil now, and there was a pullback yesterday. You can see Western Canadian Select was off by a little more than 1% to 46.57. Then south of the border, WTI up right now, bounce back, up 2.66, 2.68% to 64 even right now. After months of gains fueled by optimism over AI, equity markets have turned cautious amid a clash between disruption fears and doubts that heavy spending will yield meaningful returns. To take a closer look at how AI is impacting the markets and what you can do to mitigate the risks, we're turning to our guest for the hour, Peter Hodson, Chief Investment Officer and President at I2I Capital. Peter, today, AI good. Yesterday, it wasn't so good.
No, it's amazing how investors are shooting first and asking questions later. So every time you get a new AI solution that's released by whatever company, you can get entire sectors wiped out.
And software, for example.
Absolutely. Software has been under the targets for months now. And the amount of capital that's been lost in terms of what's happening to some of these major software companies like Salesforce and Monday and things like that is just unbelievable, considering that their actual fundamental earnings and their fundamental outlook hasn't changed. Like the numbers haven't changed. But
and they're solid too, are they not?
Well, they're generally pretty good. I mean, there are some that are decelerating growth, but it's not like these companies are losing money and going out of business. But as far as investor sentiment goes, it's basically every software company could go bankrupt next week. And it's just, there will be winners and losers. There will be companies that will be threatened by AI and suffer from AI. But it's not like these companies are sitting around waiting for their companies to disappear. Like they're implementing their own AI. They're trying to find solutions for their own clients. And the thing that I think people are missing is the data that these companies have of their customers. It's like if you're a big giant software, if you're a company, you're not going to just switch to Joe's AI company and put all your data on Joe's AI company. I mean, they have brands, they have
bought
value.
It at the corner store.
Exactly. And the data is very, very important. They know their customers. So it's going to be an interesting situation as it plays out. And I don't want to say it's time to buy, because sentiment is impossible to gauge. But some companies are going to do very well, and some companies are going to do not so well.
Are you starting to see some companies kind of pull ahead when it comes to software, or the software companies that
Not really. It's like it's basically
still all muddy.
It's basically a sell everything scenario going on right now. Now, I think there's some investors that are kind of looking, but it's like catching a falling knife. You might get cut on the way down. But as we see, fourth quarter and first quarter earnings come out later this year, you might get a bit of a bounce, a relief rally. It's like, hey, guess what? Nothing's changed in terms of these companies. But it's very important that these companies outline their strategy as to how they're going to use AI to help their own business as opposed to give someone else their business. So it's going to be an interesting year. And, there's been a big shift to hardware companies. Software is dead and hardware is great. And on the NASDAQ, both of those sectors were very highly correlated until about October of last year. And now they've completely diverged, where hardware is all that anybody wants. And it's interesting because if the software AI is going to eat software, then the AI as a group should do well, except for software. I mean, if AI is going to kill everything, then it should still be a growing business and it should have accelerating growth. So there is money to be made in certain sectors of tech, just maybe not software this year.
And it's hard not to get caught up in it, isn't it? It takes some discipline to figure out when to sit, when to dump, and how do you ride that out when all this is going on like this? Yeah,
I mean, the really only advice we can give people is focus on the fundamentals. And so there's a Canadian company called Constellation Software that's been cut in half.
It's been hammered,
Just been cut in half in maybe months. And here's a company that's only seen their stock go down once in, I think, 20 years. The stock went from $20 around the IPO level, I think $16 to $5,500. And now it's $2,200. But they actually haven't reported anything bad. They've actually made good acquisitions. They've got their own AI implementation going on with their clients, which they have about 700 to 1,000 clients. And so the numbers haven't changed, but the stock is cheaper than it's ever been. Again, I don't know when it ends and when it sort of bounces, but again, you have to focus on the fundamentals until the fundamentals tell you that things have changed. And right now, the fundamental numbers are telling you that nothing's changed yet.
It's early.
Exactly.
It's early in the
market's
day.
Not open yet.
and then the halo trade, is that what this all is?
Yeah, absolutely. So we've seen sectors like transportation, industrials, and energy just go crazy. Part of the reason is they're not vulnerable to AI. So there's yes, and well, maybe not if you sort of look through what's going on with some of these sectors. So there's the HALO acronym, which stands for heavy assets, low obsolescence. So think of big things that cost $10 billion that you can't replace, like a refinery for an energy company.
Trucks.
Or a train. It's pretty hard to replace a train with a robot. The logistics sector was laughable last week because there was a tiny company that used to sell karaoke machines that came out with a logistics thing and said it would improve their deliverability by 400% with no increase in costs.
Are they getting rid of traffic?
Well, they were a little unclear on how they did it, to be honest. It's a $15 million company, just tiny. But it took $200 billion off the logistics sector because everyone thought that was the end of trucking and the end of trains, which was just ridiculous. And so things like trucks, refineries, electrical utilities. I mean, here's a sector that can't be easily replaced. It's cost billions and billions of dollars to build a hydroelectric dam. There's huge demand coming from AI. So AI is a big tailwind for these companies. And it's a regulated industry in most countries where rates are regulated. So that's a situation where it costs a lot of money to replace and it's very low obsolescence. And you get the benefit that AI actually is a demand driver for this as well. So maybe have some old economy stocks offsetting your AI exposure.
Never hurts. Balanced, right?
Exactly.
That's the word. Okay. Peter, stick around. We're going to be back, and you're going to be talking about why Kraken Robotics is on the radar. Time to see what's on the radar for Peter Hodson, Chief Investment Officer and President at I2I Capital. And I have to do it. You want to release the Kraken, don't you?
Release the Kraken.
I can't help myself. Whenever I hear Kraken, that's all I can think of is Liam Neeson.
Absolutely. I mean, it's got some meme power as well.
Different Kraken, though, to be clear, and it's not the rum either.
Yeah, no, exactly. So Kraken Robotics it's a nice little small cap company that's done exceptionally well over the past year. So simply put, they build things for underwater exploration and defense technology. So things like sonar, radar, undersea batteries for submarines, things like that. So basically anything that's that really needs robust technology that never fails, that operates all the time in harsh conditions. So the company's done very well on a couple of fronts. Really, they've totally ridden the defense wave. Obviously, defense stocks have gone crazy with the increased spending budget that all the NATO countries have to do. And you've got a situation here where Kraken is just sort of fits right into all these new submarines that are going to get built. Then you've got the company transitioned from a $1 billion market cap. It sort of went from 500 million to $1 billion. And that brings out a whole new set of investors who never looked at the company before. And it's like, hey, look at how fast they're growing. This is a pretty good company. They did an equity issue. They're all cashed up. And they've got a lot of new contracts that are going to hit the numbers over the next couple of years. Then you've got the Anduril IPO later this year, which is a big defense company that's going to be a hot IPO. And they've already got Anduril as a customer. And that company, as Anduril starts to grow and spend their newfound capital as a public company,
where are they going to spend it?
Where are they going to spend it? And you might as well go to your existing suppliers, build some new submarines, and give Kraken a couple $100 million worth of revenue. So it's a nice little story. It's certainly not risk-free. The stock's gone crazy. It's expensive because of what investors expect going forward. But then you've got Carney going, hey, let's
that's the thing.
Let's make Canadian companies better with our defense budget, and it sort of fits right into that theme.
Especially with a track record already, right?
Exactly, exactly.
There are going to be a lot of companies come knocking at the door, going, "We know how to do that," and they probably won't. But
exactly.
This company has a track record, and it's one I was just thinking about. It's one that could hugely benefit from AI as well.
Absolutely.
Remote control robots around in the oceans.
Exactly, and there's a very good moat here. I mean, if you're a new submarine company, you're just not going to go somewhere else and say, "Oh, hope it works." You want to go to a proven supplier.
Yeah, we don't want new submarine. You want somebody who knows what they're doing when it comes to submarines. Somebody else that knows what they're doing, Magna.
Yeah. So this one
blockbuster.
is an interesting stock for us. So we have a sister company called 5i Research, and our 5i Research customers hated Magna forever, like 3, 4, 5 years. It's like, why do you think this is a good company? But it was a good company because they've gone through downturns before. They've seen lots of recessions. They've got a good balance sheet. They've got the ability to make acquisitions. They've got EV technology. They've got diversified operations. So there's nothing wrong, again, from the numbers. The stock was trading at 7 or 8 times earnings. It was just ridiculous. And then suddenly last week, everybody loves Magna, and the stock hits a new high, and they raise their dividend, and everybody loves it again. So it's really interesting how the sentiment has shifted. So one, Magna did report good numbers, better than expected, and they're kind of turning the corner in terms of what's happening fundamentally. They're managing the tariff situation really well. Who knows? I don't even know what the rates are, but Magna seems to be able to manage it.
I imagine they're avoiding a lot of them probably through CUSMA.
Yes, yeah, absolutely. But again, some of the materials and their supplies are hit by tariffs. They raised their dividend. It was only 2%, but it's like, hey, guess what? We're doing well enough to give you more money as shareholders. And then you've got the anti-AI trade, like we were talking about, the Halo trade. It's pretty hard to have software replace a car manufacturing company, but it absolutely can help them in terms of efficiency and production gains and things like that. So suddenly everybody loves Magna, even though it really is not a changed company. It was the same as before. It's just they came out with some good numbers, and now sentiment shifts, and you can get, if you go from 8 times earnings to 12 times earnings, that's a 50% boost even before earnings have gone up. So those are great stories when you've taken out the risk in the first place.
Any concerns with it if CUSMA falls apart, though?
That'll be ugly in the short term for sure. I mean, you want to have some sort of agreement. But Magna's got exposure in Asia. It's got exposure in Europe. They will adapt, and that's one of the reasons why we would say it's a decent play, because it's not just a North American play.
All right, let's get in. We got 30 seconds. Nebius.
Sure. Nebius is a company that used to be called Yandex, and they were in Russia. And they said, we're out of here. We don't like this war. We're going to leave. So they renounced the war, moved to the Netherlands, and started a data center company from the ground up. So they have 300 engineers. Their revenues are going from $500 million last year to close to $7 billion this year on a run rate. $23 billion company. It's still kind of unknown, but because they're going from the ground up, they've got contracts with Meta and Microsoft. Very profitable long-term contracts. It's just one to watch. We think it's very interesting.
Okay, we'll leave it there. Thank you as always, Peter. Still ahead, we're talking to social media's rich BFF on her latest book, and our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. And if you're shy, email us, firstcall@bellmedia.ca. Japan plans to invest up to $36 billion US in American oil, gas, and critical mineral projects. This is the first set of its $550 billion commitment under the trade agreement struck with the U.S. The investments include a natural gas facility in Ohio, where Japan is expected to invest up to $33 billion. The announcement comes weeks before Japan's prime minister is set to meet with U.S. President Trump in Washington. TFI International saw a drop in profit and revenue in the fourth quarter. The Montreal-based company says the drop was primarily due to reduced volumes driven by weaker end market demand. The trucking company raised its dividend in the quarter and repurchased more than $200 million worth of shares in 2025. The Canadian housing market saw prices and sales continue to drop. That was for the month of January. The benchmark home price fell by almost a full percent and is now sitting at about $665,000, the lowest level in almost 5 years. A senior economist with Korea says cold weather could be the driving factor right now behind the drop rather than a decline in demand. And quick peek at the U.S. futures. Some AI fears easing a little bit. You can see everybody's in the green. The Dow up by about a quarter, the NASDAQ up by 0.58, and the S&P 500 up by nearly a half. Vivian Tu, the personality behind social media channel Your Rich BFF, has just released another book, Well Endowed. She's a New York Times bestselling author, has 4 million followers on Instagram and nearly 3 million on TikTok. Here to discuss her new book and social media channels is Vivian, founder and CEO of Your Rich BFF. Vivian, thanks very much for joining us.
Thank you so much for having me.
Thank you for being our rich BFF. We appreciate it. Your new book, Well Endowed, is kind of a continuation. Where does the focus go with this book?
Yeah, so my first book, Rich AF, focused all about the basics, getting your financial house in order, things like budgeting, saving, investing, paying down debt. But Rich AF didn't cover the more nuanced moments around your life that happen. Things like making those biggest purchases, your home, your car, that insurance, how to navigate finances in your relationships, for your children, for your parents, and even how to really set yourself up for a successful retirement and then leave something behind through estate planning. And that is what Well Endowed goes over.
Vivian, a question for you just on the investment side of things. So if you're focused on young investors, I've seen a sort of a mismatch between investors that want to get rich now. They want to buy the meme stock, they want to buy the short stock and, have the short squeeze, versus the sort of the reality, which is get rich slowly is a far better thing to do. Can you sort of talk about how your followers sort of adapt to that and what you're telling them and how to manage that process?
Yeah, I think that mismatch comes from a place of feeling incredibly disenfranchised, if I'm honest. This next generation has never really seen an economy that has served them. Their parents were able to work a steady corporate job, take 2 vacations a year, end up with the 2.5 kids, golden retriever named Rover, and still manage to retire at 60, 65. But a lot of young people are feeling like if I can't hit it big today, then this likely will never happen for me. I try my best to educate the next generation that, frankly, the stories that they see online of the Dogecoin millionaire or some meme stock making somebody rich, that's, 1 in a billion, and likely isn't going to be you. Something that my mentor taught me on Wall Street was that every trade has a winner or a loser. And if there is someone out there who's made all that money off of these incredibly speculative investments, you've got just as many people, in fact, more people who've probably lost that same amount of money. And so I just think it's a little bit frustrating for me, but I tell them the tried and true method is to buy and hold in a diversified portfolio for the long haul.
And it's really changed for a lot of them. They are investing more, I think, than younger generations before. They're not looking at the house as something to own necessarily. I mean, a lot of people feel that it's out of their reach right now. That may change, but they're really focusing more on the markets. And how do you balance that for them? That they want to get rich quick, but also is a home part of your plans as well? Or do you say, no, just stay with the markets?
Yeah. So I do think that there has been a little bit of a myth perpetuated across both social media as well as just the financial space, in that if you don't buy a home, you are a loser. And I just don't think that's true. Right now, we know that it is cheaper to rent than buy across nearly all major metros. So it financially may not necessarily make sense to buy. That said, if buying a home is still part of your, lifelong dream, I'm not going to be the one to sit here and tell you not to do it. Not every decision you make has to be a pure play financial one. Furthermore, I think a lot of young people are becoming more creative. The house buying, home buying thing that our parents did was put money into a primary residence. But knowing that primary residences are the one that you live in, and likely aren't going to appreciate the way that perhaps an investment property could, or provide you the type of cash flow that an investment property could. I'm actually seeing a lot of young people have their first purchase, their first home buy, be an investment property that they then further rent out versus having it be their primary residence.
Vivian, one of the issues that we see in Canada is no one focuses on deaccumulation. So assuming one of your followers has done very, very well, it's time to retire. Do you have any good tips for them in terms of how to sort of take that money out and start coasting with the money they've made?
Yeah, I always say make sure that your income from investments essentially replaces your income from labor. If you are able to have a certain set of money that provides you your quote unquote yearly income at a very dependable, consistent return. So say you get a 4 to 5, maybe 6% return on your investments, and that amount of money, those returns can cover your lifestyle, you can actually consistently take that amount out. Furthermore, I think something that folks who are certainly of higher net worth are really interested in doing is actually borrowing against those investments so that those dollars coming in the door don't necessarily count as income. So I think there's a lot of strategies to it, but what I would say makes the most sense for the average person is to keep it simple and just make sure that their dollars invested can essentially provide them a year's worth of income every single year so that they never eat into the principal.
We just got one last question before we go. Thank you very much for joining us, Vivian. This is probably one of the most educated generations when it comes to finances. Does that make it easier, or does that make it harder and more dangerous in some ways?
I think it can be both, to your exact question. Yes, I think it's incredible that the way the internet has essentially democratized access to this information. But I think the most dangerous thing is someone who knows a little bit, right? Because if you don't know anything and you feel very lost with your finances, you won't make any major moves in the hopes that it'll make you a bunch of money. But once you start to know enough to be dangerous, you might start to think that you know more than you actually do, and thus end up making some decisions that aren't necessarily prudent. What I would encourage people to do is not just know a little bit, but make sure to do your research on every single financial decision you're making in your life, because it is important. Unfortunately, the work that I do versus, something of a more traditional lifestyle influencer, the consequences are vast. If somebody tells you, you should buy this $12 lip gloss and it ends up being terrible, you've wasted $12. And, unfortunately, that's $12. But if you are taking information from online about investing or budgeting or paying down debt and you make a wrong move, the consequences could be in the thousands. So one, I take my job very seriously. And I always say, don't trust everything you see on the internet, even if it's from me. Just double check, make sure that you have a couple different reputable sources telling you the same thing.
All right, Vivian, thank you very much for joining us. We appreciate it.
Thank you so much for having me.
Vivian Tu is founder and CEO of Your Rich BFF, and her new book is called Well Endowed. Still ahead, today's market drivers with Bloomberg's Divya Balji. And of course, our phone lines are open. Peter Hodson, Chief Investment Officer and President at Eye to Eye Capital, is taking your questions. 1-855-326-6266. You can also email us, first call at bellmedia.ca. All right, let's take a look at some early market movers. We're joined now by Bloomberg's Divya Balji. Divya, thanks as always for joining us. And with everything going on with AI, people are liking Apple again.
Yeah, I mean, it's a little bit of a twist in the story here. If you're looking at the turmoil and the volatility that we're seeing in the market right now when it comes to AI, people are looking for these haven stocks that they can still put their money in. And Apple is standing out as one of those in the tech sector in and of itself. I think for the first time in a very long time, the fact that it barely spends any money on AI, that it doesn't have a huge investment in AI, it isn't part of the whole Anthropic issue that we saw a few weeks ago. A lot of this is actually helping with its share price right now. The stock is up, a little bit, not too much, not in a massive way, but, investors that are looking to capitalize and buy the dip in this current moment throughout this turmoil that we're seeing with AI stocks and across the board in the S&P 500, Apple is being seen as the beneficiary to that right now. If you were to think about it, every earnings season when the market is looking at Apple to see what it's going to say about AI, and when it doesn't talk much about AI, its stock gets punished. In this case, it is the complete opposite right now. It is becoming a bit more of a haven stock for investors trying to buy the dip here throughout the sell-off that we've seen with AI stocks.
Okay, and the New York Times shares are up. We don't often say that about a newspaper, but they're up right now. Berkshire's interested in it.
Yeah, so, it had its 13F filing last night, and what we saw is in the last 3 months of the year, it built up a stake of over 5 million shares. That's worth over $300 million. Now, I think if you think about this, this is something where it is a company that has been focusing more on the digital platform that it has. There is an analyst out there saying that that focus means there could be higher profit margins, which could also help lower variable costs, considering you don't put a lot of money into subscribers actually paying to read news on the internet. So I think that's really possibly one of the reasons why Warren Buffett, in his last 3 months at the company or last couple of months at the company decided to invest more in this stock. I think if you were to look at the shares of New York Times in and of itself, it's had a really good run for the last 3 years. 2023 was a 50% increase. 2024 was 6%. Last year it was over 30%. And in the last 3 months of the year, last year it gained about 20%. So really good gains, unclear when Berkshire actually bought the shares, but still a pretty good investment if they did at the start of the quarter last year.
Indeed. All right, Divya, thank you for that. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Gemini Space Station. Let's take a look at some of the notable analyst calls and recommendations. Palantir shares are up in pre-market trading after Mizuho Securities upgraded the data analysis software company to outperform from neutral on spectacular growth and expanding margins. Analyst Greg Moskowitz says the company is in a category of one, delivering total revenue growth, acceleration, and margin expansion at scale that is unlike anything else in software that we've seen. Price target is set to $195. Gemini Space Station downgraded to neutral from overweight at Cantor Fitzgerald and had its price target cut at Needham & Co. to $8 from $14 after the crypto firm said that 3 of its executives were leaving the company on Tuesday. Analyst Brett Knobloch notes that executive departures, recent layoffs, and crypto market weakness make it difficult to be positive on Gemini's shares at their current level. Bristow Group was initiated with an outperform rating at Raymond James, which says that oversupplied oil markets and aircraft component supply constraints are tailwinds for the aviation transportation provider, and it's set at $60 US. While market turmoil unleashed by AI advances points up 2 seemingly contradictory fears about tech, that it won't fulfill its very expensive promise and that it will swallow up vulnerable industries. Bloomberg Originals has more.
Wall Street is suddenly waking up to the fact that AI might impact a larger number of industries and faster than they had expected.
What this story is about is how AI disruption fear is leading to sell-offs in parts of the market outside technology. On Wall Street, rising fears about artificial intelligence, and specifically where it will disrupt certain companies, are sending shares of those companies tumbling.
Wall Street has done an about-face. Investors were concerned that AI was costing too much and might lead to a big bubble with untold harms. Now investors are concerned that AI is going to be so disruptive that it renders countless businesses obsolete. There's definitely been a spillover, starting with concerns about legal services, SaaS companies, heading into insurance firms, tax preparation services, financial services, each of these in reaction to incremental AI products. The market sell-off really started in early February when Anthropic introduced a plugin to an existing product, one that they did not even really do a formal announcement for.
So what we saw on February 10th, for example, was shares of wealth management companies sell off after Altruist, which is a little-known AI startup, came out with a new tax strategy tool. Look at the stock slides of companies like Salesforce, Charles Schwab, and Blue Owl. Investors are concerned that AI might be able to replicate their offerings soon. The fear for investors right now is that they're going to get caught up in the next version of this sell-off, and so they're really looking for ways to avoid that.
Let's take a step back. In November of 2022, OpenAI kicked off the AI boom. When ChatGPT launched, people were mainly using it to spit out clever song lyrics and poems and pithy responses to things. But what we've seen in the last year or so is that people have been using these to shop for products online, do more advanced online research, and even build apps from scratch with little expertise. Wall Street now seems to be waking up to the fact that those same tools can be used across different sectors.
These tools are coming out and they're good. And so what we're seeing is investors really worried about the parts of the market that are tied to AI risk and looking instead to go more into the AI winners. This chart depicts two baskets of US listed stocks from UBS research analysts. One is AI winners and one is AI risks. So you can see there's been a massive divergence as investors look to avoid companies associated with these risks and flock towards the AI winners.
That technology has been very disruptive in a certain corner of the world, particularly Silicon Valley. But in recent months, it feels like there's been a mainstreaming of it, where we're seeing broader awareness, right? You can use that same technology in your everyday life or in other sectors, even if you don't really want to code.
We've seen video game stocks get hit after a new Google Gemini launch. We saw insurers get hit after a startup came out with a new product. And even more recently, real estate stocks are selling off as investors think that this could be the next place that's going to get hit.
At the moment, Wall Street seems to be whipsawing between two different, extremely opposing views. There are investors who are concerned that tech companies are spending too much money to build AI services with an uncertain payoff. On the other side, investors are anxious that AI will be so disruptive that it renders numerous businesses obsolete.
I've definitely heard sources say that they just don't understand how both of these things can be true at once. They don't think that these knee-jerk reactions would be happening if we weren't near record highs on the S&P. We don't know what next feature or new product is going to be released that sets off the next sell-off, so really we're just watching to see what happens next.
Unsurprisingly, it's hard to predict where things go from here. What's clear is that the large AI developers and a long list of AI startups plan to bring advances to more and more sectors as they try to make money from this technology. So we should expect that if Wall Street is now worried about how disruptive AI could be, there will be plenty more moments in the months ahead for them to be concerned.
And when we come back, Peter Hodson takes your questions on First Call. All right, time for First Call, and Ted from Newcastle, Ontario, is our first caller. Hey, Ted.
Hi, my question's on BlackBerry. Is this a good entry point with its recent pullback and with all the software panic selling? Thank you.
Oh, poor BlackBerry. We're actually based in Waterloo, and it's a situation where half my friends used to work at BlackBerry.
Ouch.
We've got a situation of declining revenue, and you've got a situation where they had a great balance sheet with billions of cash that's disappeared. So while it is a bit of an anti-AI play, there's just no growth there to get us excited. So unfortunately, I wouldn't recommend it right now.
Really? Oh, that was short and sweet. I watched the movie on the plane. I haven't seen the last 25 minutes, so don't tell me what happens to BlackBerry.
It is accurate, though.
It is accurate.
Yeah.
It was interesting, and it was fun to see a Canadian story. Unfortunately, we know the finish of it. Okay, let's get back to the phones. And Bill from Bowmanville, Ontario, what's your question?
Thank you for taking my call. I'm asking your guest what he thinks of Celestica and would he buy it at this level? Thank you.
All right.
Sure. So we were talking earlier about hardware versus software, and Celestica is absolutely on the hardware side. So all of the big data center companies are their customers, and so they do sort of outsource manufacturing for these guys. But the other thing is Celestica shifted from a just-in-time manufacturer to working with their customers. So the old Celestica only got business when things were booming, and now they're getting in bed with their customers and they're developing products. And so from a hardware point of view, it's a really attractive story. They continue to beat their numbers. It's great momentum in the stock. It's not that expensive, and they're completely tied to some of these very, very fast-growing companies. So if you don't like software, you have to love Celestica. So we think it's pretty attractive right now. We'd be buyers.
Would you call it a halo? Would it be a halo within the software?
Yeah, because it's
I'm stretching.
Yeah, you are a little bit. It's not like an oil refinery halo, but certainly. Yeah, as the AI spending machine continues, and certainly it looks that way based on everybody's comments from the big companies, I think you've got 24 months here before you have to worry. But beyond that, things could change, and you will have to get a return on investment with all this AI spending.
All right, what might be a concern for Celestica?
Really, just if some of these AI companies say, hey, guess what? Instead of spending $200 billion, we're only going to spend $100 billion, that would be a negative. And that's not going to happen this year. But as next year, what's going to happen next year? Are they going to go from 200 to 300 billion? I'm not so sure about that. So you have to watch the deceleration potential of growth.
Okay, and let's get into an email now from Jimmy. And he says, I'm often puzzled by different analyst ratings. Peter, will you describe the meanings behind the analyst ratings and background suggestion, strong buy, buy, hold, sell, and watch.
Well, the problem here is there's so many other ones. There's a market neutral, and there's hold, and there's equal weight and things like that. But basically, if you see a strong buy, then the analyst is putting his or her name on that stock, and it's probably a better buy than just a regular buy. You got to watch out for holds because analysts still don't want to offend companies. There's still that business that's going to come from investment banking and things like that. So you can almost say a hold is a sell from a Bay Street or Wall Street analyst. If a hold means they don't like it at all, and they're not even willing to put a buy on it. If you get a sell, and we've seen strong sells, that's about as big a call as you can say, just get out of this now.
Yeah.
But you have to remember that these analysts they have their favorite companies as well. And if they're analyzing 20 companies, they might not be paying that much attention to the bottom 3 or 4. So they might put a sell on that just because they haven't done the work and they don't want to sort of be caught if it goes bad. But it's very hard to look at, and I would rather just read these reports, read the analyst reports, get the information, and then make your own decision. Because there's a lot of conflicts and there's a lot of confusion, and one person's strong buy isn't even close to another person's strong buy, and you still have that absolute bias towards buys. If you look at a company with 40 analysts, you'll get 32 buys, 7 holds, and 1 sell.
Really?
Yeah. It's really...
there is that much bias still.
Even though the regulators have tried to change that and change the way analysts are paid versus investment banking business, things like that, absolutely. Like if I don't have the numbers in front of me, but if you looked at every analyst rating, it'd be 80% buys.
All right. We'll leave it on that note there. Peter, thank you as always for joining us.
It's
Appreciate it. That is it for us here on The Street. Thanks to Peter Hodson, Chief Investment Officer and President at I2I Capital, for joining us today. Andrew Bell's up next with the Open. Trading gets underway in about 30 minutes from now. Have a great day.